So the approach that we're taking, and I'll revert this back to Primark, is the U.S. has both endemically and systemically relied on excess leverage, high levels of mortgage debt, to float the boat to get people into homes. And then we talked about that homes, or housing, residential real estate, is a volatile asset class. And so what we envision going forward is lenders can't afford to lend that much against the price of a home. Thus, you can conclude there's a delta in terms of what it requires for someone to buy a home, which requires equity capital. One of the challenges that's been around for a long time is people that want to buy homes, they have to put a down payment. But 82%, I think 82 or 85% of would-be homeowners can't buy because they don't have sufficient down payments. So that's a problem. So either they don't do the deal, or they find other mechanisms. Maybe they have friends, family that step up, which is great. But a lot of people don't have that option, so they borrow more. They find some other lender. They find a lender that basically will step up and say, we'll give you 90% or 95%, which is, again, the problem. So our approach is we have to change basically the capital structure of home ownership. That is, there's got to be a higher component of equity capital in the mix. How does that happen? We believe that we have to take an approach that the equity component may not, or housing may not continue to be sort of a single investor, single owner, much like other asset classes which promote and practice shared ownership, such as a company. You have a lot of shareholders. Bond issuances, you have a lot of bond holders. Interesting, as the single largest asset class, that is residential real estate, the concept of shared ownership doesn't exist because there's so much mortgage debt available. Shared ownership, but let's look at this in the context of just the United States. The states are unusual. If you look on a global basis, whether it's through Asia, Europe, the concept of shared ownership, shared equity, whether that shared equity comes from private sector sources, public sector sources, is a means by which to move people into homes, into home ownership. In fact, Islamic financing prohibits banks from charging interest, or riba. And so what do banks do? They basically become equity partners in the home for their client, and they share in the profit participation. They also share in the depreciation if, in fact, the price goes down. Unlike in the United States, the lender, the mortgage lender, always gets their money out first, and the equity investor, namely the homeowner, gets stuck. So the concept, and one other interesting point in the United States, that the use of leverage is even built into our tax system. Interestingly, if you look at all the G20 countries, the United States is only one of 5 countries that still allow for the mortgage interest deduction. So even our tax law support it. You've got Sweden and Finland and Switzerland, us, and I can't remember the other, but everybody else has dismissed the use of debt by not having the mortgage interest that you pay being deductible for tax purposes. So anyway, the approach, I founded recently a company by the name of Primark, and our approach is really to change the way homes are financed. That is, there's got to be a higher component of equity. And so the method by which we're using is actually to create a capital market system. So think of NASDAQ, where you can come in and buy shares of stock. Well, our view is why not create the same capital market system, but for the purpose of providing equity for residential real estate, third-party equity, whereby an investor can come in and supplement a homeowner's or a home buyer's down payment and have a small piece of the equity. And with the hope that that equity, that home, will appreciate over time. whereby the investor can reap the returns of the appreciation. Certainly, the contractual relationship between the homeowner and the investor can get complicated, but we've sort of worked that out. We've got a lot of the best and the brightest in the country working with us. Those that follow housing, for instance, may be familiar with an index called the Case-Shiller Index, which tracks home prices over the course of time. Well, Bob Shiller, a professor from Yale, is on our advisory board. He's a well-thought of, well-spoken gentleman. Another gentleman that sits on our advisory board is a professor out of NYU, Andrew Kaplan, who's the foremost authority on equity sharing literally in the world. And they all subscribe to our vision that we can recreate, or we can change the rules of the game. Our approach is a paradigm shift in terms of housing finance. In fact, one of the things we joke about is, while we want to create the size of the company of Google, Google, we also want to win the Nobel Prize in economics for changing the game. So our approach is to create a NASDAQ-like market where global investors can actually review investment opportunities. Those investment opportunities is to co-invest with would-be buyers of homes who don't have down payment capital. And so on a $500,000 home, instead of borrowing 90% or $450,000, you bring in an equity partner for an extra 50. Well, that 50 reduces the size of the loan, which basically makes home ownership more sustainable. And what I mean by that is that the payments are lower. The problem with mortgages are twofold. I wrote a paper for the FDIC a while ago assessing mortgage risk. Well, there's two fundamental risks. You've got payment risk, that is, the homeowner can't afford to pay it, and that's one of the problems we have. And secondly, the value of the collateral is going to diminish, and so the loan is in excess of the underlying value, which we've experienced too. And so in both circumstances, the problem is there's just way too much debt on these properties. So how do we address that? By providing equity capital. And again, our approach is to create a global capital market where third-party investors can actually enter the market and provide that equity capital. And we've got some unique nuances to the market whereby an investor who comes in, real estate historically has been fairly illiquid. It takes a while. Oh, you want me out? Okay, fine. Real estate historically has been illiquid. One of the elements of our market is that if I happen to invest in someone's purchase of a home and I have, say, for example, $50,000 in it, how do I get out as an investor? Well, one can say the home's got to be sold. Well, let's say the homeowner really doesn't want to sell the property. Or they can refinance me out, but let's say the credit markets don't allow that to happen. Well, within our market, I can take my equity interest in one's home and resell it to another investor. So in effect, our market creates liquidity in a very illiquid space. So again, it's a big paradigm shift in terms of how housing's financed, which is in the U.S., which is completely archaic. It's disruptive, it's destructive, and things have to change. And so we return to the Silicon Valley and say, let's change the game. And so hopefully over the next handful of months and years, you'll see Primark alongside NASDAQ, the London Stock Exchange, and you know where it started. So thank you.